So good afternoon, good morning, good evening, everyone, depending where you are. Welcome to today's Future of Financial Information webinar. It's actually our last episode of the webinar season, but the FutFinInfo season is actually far from over. So let me just remind you that in exactly 2 weeks, we will start our annual conference. So with 3 days of exciting presentations, 3 keynote speeches. So I think it's well worth checking out. And it's online as is still the norm. So participation is on Zoom, and it's also free. And Marina will also be there. So that's one more reason to actually register. But meanwhile, I'm very happy to have her with us today, presenting in the webinar series her work on disagreement and informed trading. So, 2 things that make this paper a great fit for the series. And I'm also very happy to have Clifton Green from Emory University, who will discuss the paper. So just a little bit of housekeeping. Marina will present for about 30 minutes, and then Clifton will discuss for about 15 minutes, and then we'll spend the rest of the time until the 1-hour mark on the Q&A with the audience. But please don't sit on your questions until the end. Feel free to put them in the chat. I will be keeping an eye on the chat, and if there's something that needs an urgent clarification, I might actually jump in during the talk, and otherwise I will come back to your questions at the end. So now, without further ado, Marina, please, the screen is yours for 30 minutes.
Okay, I'm on mute now. Okay, so play from current slide. Can you guys see everything?
Yes, you're good to go.
Okay, perfect. So thank you very much for having me out again. So this is joint work with Tony Cookson and Slava Fos, and this is still quite early work. This is actually the first time I'm presenting the paper, and Tony has presented a couple of times. But we really look forward to Clifton's comments, and any other comments and suggestions you guys have would be greatly appreciated. So let me kind of give you a little bit of a background for the paper. So there are a couple of distinct literatures out there. On the one hand, there's a literature that looks at disagreement and how it relates to trading volume. And especially if you think about the theoretical part of it, a lot of the theoretical concepts include some behavioral sort of frictions, in the sense that often you need some behavioral assumptions where investors agree to disagree. And because of that, people often think about sort of disagreement, thinking about noise traders or sort of less sophisticated investors. And even empirically, a lot of sort of the disagreement literature and how it affects trading volume has focused on the less sophisticated traders. There's also at the same time, like literature emerging, and maybe this is not too surprising, but it turns out sort of sophisticated and informed investors have often, or traders, have often sort of a disproportionate impact on financial markets and financial market outcomes. For example, there's a recent paper by Koigen, Richmond, and Yogo that look at, sort of highlight the role of hedge funds and informed investors on market outcomes. So what we're going to do in this paper, we're going to combine the 2 literatures in the sense that we're going to try to understand why disagreement among often sort of unsophisticated or uninformed investors can sort of affect market outcomes. And in particular, we will look how it affects informed investors. So we'll have a mechanism where basically our stories are, disagreement will impact behavior of informed investors, and sort of our suggestion is this is how it affects sort of aggregate trading and equilibrium, or at least partially. So what are empirical challenges in terms of answering this question? So first of all, it's always tricky to identify informed traders. We have now ways to think about sort of institutional and retail investors, but obviously trading by institutional investors is not always informed trading. So one question is, how would you think about identifying informed traders? The second is, how do you measure disagreement? And so far, a lot of literature has focused on, for example, disagreement among, or sort of analyst forecast dispersion, and that could be measured at monthly level at best. And then you always, kind of at least to my third point here, then you always have an issue when you contemporaneously measure disagreement and trading. Then it's unclear whether disagreement is sort of leading the trading volume or whether trading volume is leading the disagreement. And so we actually have a way to get around these three challenges in our paper. So first of all, we're going to study activist investor trading in the 60 days window that precedes 13T filings. And I will talk about the details in a couple of slides, but this is something that Slava has spent quite a bit of time studying. And so there's a kind of evidence that during that 60-day window, that these are informed investors. So we can cleanly identify informed investors in our setting. Then the second challenge is how to measure disagreement. Here we're going to rely on a paper by Tony and myself, where we use sentiment stamped tweets from a website called StockTwits. And again, I'll talk about that more in a second. We were able to identify sentiment and therefore measure disagreement among investors at the daily and even sub-daily level, because we have exactly the timestamp. And this is how we can get around some of the issues mentioned in the third challenge here. So first of all, you think about, obviously, if investors are aware that activists are trading, it's not surprising that that can lead to a lot of disagreement. However, during this time, actually, we'll see this is silent trading. So only exposed do activist investors have to disclose that they were trading during this window. And so it's unlikely that the idea that activist investors are trading will cause the disagreement. However, you always have the problem that, well, maybe people don't know that activists are trading, but obviously they are trading, so people can observe volume and potentially return movements. And so you might still have kind of this reverse causality. And as I mentioned, we're able to go in our paper intraday. We'll split the day in two parts. In particular, we'll look at the overnight window of the prior day to then look at how disagreement during that time, to look at how it affects trading during the day. And again, I'll kind of elaborate on all of this in a second. So let me first talk a little bit about this idea that activists are informed traders. So first of all, what are we looking at? So activists, think Carl Icahn, typically accumulate shares by trading anonymously in the secondary market. And as soon as they reach the 5% threshold, they have to file a filing with the regulators within 10 days of reaching that threshold. Beyond that, they also have to disclose in the 13T filings the timing and the amount of all their trades in the past 60 days prior to achieving the 5% threshold. And so how do we know that these are informed investors in the sense, like, what does that mean to be an informed investor in this setting? Well, usually when activist investors are buying up shares in a company, they're doing it with a purpose in mind. And here's a graph from one of Slava's papers. So on the left-hand side, here's abnormal share turnover. By left-hand side, I mean the left y-axis. So in the bars, this is abnormal share turnover. On this axis is abnormal buy and hold returns. And here's in case it's too small, in red, I highlighted the filing day. And so we see two things here. First of all, in terms of, so they only report their trades in the 60 days prior to the filing, but we can actually see that a lot of trading happens sort of kind of right up before the filing date. So they really ramp up their buying during that time. And that is something we now check in the paper, that our results are not sort of driven by just by this time period, because obviously there's a lot of trading here. Second, what you can see here is that the returns, they're flat for a while. Then right before the filing date, they start going up, and there's several explanations. There was actually in 2015, SEC was looking into what's going on here, because that looks a bit suspicious. But what we care about, that you can see on the day of the filing, the price jumps up a bunch and then it stays high for a while, suggesting that, so these are informed traders, these guys know that they're about to try to change something at the company, and so they know that the price is going to go up, and while they're trading, that is not something that other investors in the market are aware of. So we think we have a pretty good case for why activist investors are informed investors in this market. And obviously Slav again has published several papers using that idea. So what are empirical kind of challenges, channels and tensions in our paper when we think about how disagreement among potentially mostly unsophisticated investors might impact these informed traders? So you might think about two channels. So on the one hand, and if you just, again, this is more of a theoretical thought exercise. On the one side, there is this idea that disagreement can lead to overpricing. So basically, when you have a bunch of people disagree and they're short sale constraint, there's an idea that because of the short sale constraints, the views of the pessimists will not get incorporated into prices, and so you will have some period of overpricing where you mostly have the views of the optimists reflected in the prices. And I mean, maybe not surprising, but there's also literature to support it. Activist investors don't want to trade when they feel the stock is overpriced, and so from this angle, disagreement can actually discourage activist investors from trading. On the other hand, disagreement can improve liquidity, and often through sort of noise trading. And I mean, again, not surprisingly, activists care about liquidity because not just activist investors, any informed trader wants to be able to sort of hide their trades. And so if they think there's certain days when there's more liquidity, that might facilitate their trading. So these are the two channels that we're going to pitch against each other and see which one might be actually happening in the markets. So let me quickly just go through what we find, and this is a little bit of a layout of the talk. So first of all, we look at the 60-day window prior to 13D filing, and we find that one standard deviation increase in overnight disagreement increases the likelihood of an activist trading during that day by 2%. So that's the extensive margin. So the probability that an activist actually trades on that day increases. And also we look at the intensive margin, and we find that not only is it more likely that the activist is trading, but also conditional on trading, they trade more. So one standard deviation increase in overnight disagreement actually increases activist turnover by 4.6%. So this is kind of the main result. So it looks like disagreement is related to activist trading. But next, we sort of examine the channel, and it looks like our main result supports the liquidity channel, and so do our kind of follow-up tests. But we find that during this time period, disagreement predicts liquidity. Overall disagreement predicts liquidity that we measure by Amihud and bid and ask spread, but not returns. And we also find that disagreement predicts non-activist turnover. So here, this is mostly uninformed turnover because the only people that are informed about what's about to happen in the market are activist investors. And we also look, we can use this control for the explanation approach, where first we find that disagreement seems to increase activist investing, and then we control for other aspects like returns at the same time, liquidity and non-activist turnover to see whether we can sort of make our result go away. And it looks like that non-activist turnover explains our link between the disagreement and activist trading. So this is also, so I will kind of show you results more or less in this order. And before I talk a little bit more about the data and then show you the results, I want to talk briefly about sort of where we think we contribute. So as I mentioned, first of all, we provide a bridge between mostly behavioral and sort of disagreement models. So often think about noise disagreement among uninformed investors, and mostly rational models of sophisticated trading. So we think about how in equilibrium does disagreement by noise investors affect market outcomes through trading by informed investors. And this is also sort of complementary to the paper that actually discussed by Clifton a couple months ago here. And they look in their paper at Robinhood investors. And again, you might think, well, Robinhood investors, they're sort of small traders. How could they affect market outcomes? Well, it turns out it's through their effect on sophisticated traders, which are high frequency traders. This is sort of a similar idea. And so we can sort of provide a reason why we think disagreement can affect market outcomes that sort of has been documented. We also, so disagreement is, again, been shown in Tony and my paper where we use this disagreement measure as well. That's kind of what we find, that disagreement does affect trading. But we also kind of through this paper show that disagreement can have real effects, in the sense that it does seem to facilitate more activist trading. And there's a lot of literature, obviously, that activists have real effect on companies. And so through our channel, we show that disagreement can actually have real sort of effects on real firm outcomes. And we also contribute to the literature on activists, where this is sort of the first paper that kind of puts this idea of whether activists, kind of how disagreement affects trading, and whether it's through the liquidity or through the valuation channel. And as I mentioned, we'll find that it's through the liquidity channel. So let me, before I show you some results, let me talk about data and our measurements in the paper. So I already talked about activist investors. So let me next talk about our disagreement measure. So as I mentioned, we use the StockTwits data that Tony and I have sort of used in a prior paper. And this is basically this is the largest investor social network. And this is very similar to Twitter, but about stocks. So here's an example of how you can write a tweet on this website. So if you have an account, you have your image here, and then you can, now they actually expanded it. This is a recent example to more characters, but it used to be during our sample that it's 140 characters. And you can write, whatever you think about a stock. If you want to talk about a particular stock, you need to hashtag it. So here you can, $GME, $AMC. And then one next feature that we use here is you can click whether you're bearish or bullish on a stock. So not only, we can always extract sentiment from a tweet, but that can be quite messy. So for a lot of tweets, we actually cleanly observe the sentiment, whether the investor is bearish or bullish. And we use this sentiment to construct our high frequency disagreement measure. And in particular, again, this is based on our paper, but if you think about a bullish message as being 1 and a bearish message having sentiment of -1, then as it's written here, the disagreement measure is the square root of 1 minus the average sentiment squared. And let me quickly give you some intuition behind it. The idea is very simple. If everybody agrees on if everybody is bullish or everybody is bearish on a given day about a given stock on this website, then the average sentiment squared is going to be 1 and the disagreement is 0. So if everybody is bearish or everybody is bullish, there's no disagreement, so our measure is 0. On the other hand, if people are the other extreme is that half the people are bullish and half the people are bearish, that is sort of the max disagreement, then the average sentiment is going to be 0 and disagreement is going to be 1. So disagreement will be somewhere between 0 and 1, depending where between everybody agreeing and everybody sort of half disagreeing the day the stock observation fits. So that's how we measure disagreement. And we look at it, when we say a day, we usually look at, so today's Wednesday. So if we say what's disagreement on Wednesday, we'll look from close of the market on Tuesday to close of the market on Wednesday. And as I mentioned, for a lot of the analysis to get a little bit more at what leads what, we split the day into 2 parts. So we have what's called overnight disagreement. That is disagreement based on messages that were posted from, so again, if today's Wednesday, from close on Tuesday to this morning, to open this morning. And then during the day is from open this morning to close today. So then we have sort of disagreement measure overnight that happens before we observe any trading. So I won't spend too much time here, but basically the StockTwits is a huge data set. We have 8 years of it. We end up with 16 million firm day observations. And then Schedule 13D filing, we have 1,400 events. So an event means when the filing happens. And again, we focus on the 60 days prior to the filing period for most of our analysis, because that's when we see the informed trading. So that's our setup, what our paper is about. That's the data we use. So let me show you results, and I'm going to show you results sort of in little compartments. So first, we want to establish that in the overall sample. So right now we're not looking at 60 days, we're looking at the whole sample. And we actually want to make sure that disagreement affects any of the things we're talking about, returns or any of the liquidity measure or turnover, because if overall disagreement doesn't affect anything, then it shouldn't affect anything with activist investors, and we have no paper. We do have a draft, so there are some effects. So again, preliminary, let's look at, so first we'll look at overall turnover on the left-hand side, so right here. And then we look at disagreement, and then we'll also look at separately at night and day disagreement, because again, one is leads trading versus the day disagreement is contemporaneous. And we're looking over entire sample period, and I'm not going to show you controls just for brevity, because otherwise it's tons of results. So everywhere we have disagreement, we always control for the number of messages, because that helps us sort of a little bit separate disagreement from attention. We also control for turnover in the prior days and activist turnover in the prior day to capture some information and environment on the day leading up to this. And so as you already see, we find, so first of all, we find that overall disagreement is associated with turnover positively, but also more importantly, disagreement overnight. So just to interpret it, a standard deviation increase in night disagreement associated with a 9% higher increase in turnover sort of the following day. And we also look at liquidity measures. So here we're looking at Amihud, and the paper will also have bid-ask spread, and we get similar results. And again, remember, Amihud is an illiquidity measure. So the higher the number is, the more illiquid the market is. And so we have a negative sign here suggesting that that's a decrease in the liquidity or increase in liquidity. So a standard deviation increase in night disagreement is associated with about 2% increase in liquidity the following day. So it looks like greater disagreement sort of signals a more liquid trading environment for informed traders. Lastly, we'll look at returns. And again, this is our overall sample, and we find that, interestingly, overall disagreement is strongly associated with returns. So these are returns sort of in percent. So standard deviation increase in disagreement is associated with 9 basis points higher returns. However, when we look at the relationship separated by night and day, we find that there is no relationship between night and disagreement and returns, and it's most all contemporaneous relationship, which could have 2 explanations. One is returns move, and that's what causes disagreement to move, or that there is a lead lag relation between disagreement and returns, but it sort of happens at a very high frequency, which is what we can't pick up with disagreement with our night and sort of day split. We don't have any more evidence on which one it is, but it looks like at least night disagreement does not affect returns. So far the preliminary evidence suggests that disagreement does affect an overall sample turnover in general, and it also affects liquidity. So that already suggests probably some evidence for liquidity channel. What we want to do next is to look at the 60-day window and to then try to sort of drill down the exact mechanism. So first, we're going to look at activist trading. So far, we have sort of more full sample broad evidence. Well, does disagreement actually affect activist trading? That's one sort of prerequisite of our mechanism tests. So now we're going to focus on the 60-day pre-file period instead of the whole sample. This is when activist traders are privately informed. And again, as I mentioned, the advantages activist trades are not publicly known, and we can use the sort of overnight disagreement to try to remove some of the reverse causality concerns. And first, we're going to just look at activist trading as a function of disagreement, and then disagreement at night and day. As always, sorry, I forgot to mention earlier, we have firm and date fixed effects. We also cluster our standard errors by firm and date. And we have controls for number of messages, lag turnover, and lag activist trading. And as I mentioned earlier already, I alluded to activist trading. We'll look at two parts. We'll look at the extensive margin. So are they more likely to trade on a given day or not? And then we examine the intensive margin, as in, are they trading more when they do trade? So let me show you the activist trading results first. So again, on the left-hand side, we have activist trade dummy times 100. So again, that's whether an activist traded that day or not. And then on the right-hand side, we have first overall disagreement, and then we have split by disagreement night and day. And here I will show you turnover in the prior day and trade dummy just to can compare some coefficients, but otherwise I will suppress all controls. So we can see that, again, overall disagreement is positively associated with activist trading, but so is night disagreement. And a standard deviation increase in night disagreement is associated with 2.3% higher probability of trading the following day. So on the extensive margin, activist investors do trade more when there's more disagreement overnight. And also notice, that's what I wanted to point out, that this coefficient is twice as large as coefficients on sort of other determinants of trading by activists, which is turnover in the prior day and whether they traded in the prior day. So they're more likely to trade in consecutive days and when there was higher turnover, but it's more so when controlling for that, sort of disagreement overnight has an important effect. So next, we'll look at the intensive margin. It's the same idea. I won't spend too much time here, but basically, we have now activist turnover on days when they do trade on the left-hand side, and we find that a standard deviation increase in night disagreement is associated with a 17% increase in amount, in amount of activist trading the following day. And actually, this is much stronger than the association between the amount sort of contemporaneous disagreement and activist turnover, partially again confirming the idea that activist turnover is not publicly observable, and so so there's sort of that turnover is not strongly associated with disagreement. Okay, so far what I've shown you were overall results in the broad sample, suggestion that disagreement does have effects on liquidity, etc. And the disagreement also affects activist investor trading. So now let's look at what is the channel. Why does disagreement affect activist trading? And so first we're going to look at the 60-day time period. Again, we'll look at returns, liquidity measures, and non-activist trading. And what we have here is, and again, we'll look at the whole 60-day period, activist trading days and non-activist trading days. And we see that disagreement overnight, as we saw early in the broad sample, so maybe not surprising, there's a weak predictive relationship on the days where activists actually are trading, but it's very weak and it's much more strongly contemporaneous, especially on the days where they're trading. So it's unlikely that return channel or this valuation channel explains the reason activist or disagreement affect activist investors. Next, we're going to look at liquidity measures. And again, now we have AMI-Hood and bid-ask spread on the left-hand side, the same setup as before. And actually, in the 60-day time period, we do not find that there's no predictability between disagreement overnight and traditional liquidity measures, so AMI-Hood and bid-ask spread. So next, we're going to check whether, again, these liquidity measures only capture a certain aspect of liquidity. We will look whether kind of turnover by ex-activists, and it's not former activists, it's non-activist trading. And the reason we call it that is because we've defined non-activist trading several ways. We looked at just turnover by overall turnover minus activist turnover. However, you'll see we also include that variable into when we have activist turnover on the left-hand side. So it's so weird you have activist turnover on both sides now. So we measure ex-activist or non-activist turnover by just regressing overall turnover on activist turnover. So we basically orthogonalize it. And what we find is again, it's the same setup, a very strong predictive relationship on days when activists trade between disagreement overnight and non-activist turnover, or turnover by people that are not informed. And also we find that activists are more likely to trade on days when overnight disagreement affects ex-activist turnover, because you can see the coefficients are much smaller on days when activists do not trade. And again, this is not mechanical because by definition, ex-activist turnover is uncorrelated with activist trading. So the last results I'll show you. So far, we found that, again, disagreement affects activist turnover in that 60-day time period, but it doesn't seem to affect returns or traditional liquidity measures. But the one thing it does affect is like non-activist turnover. And now we look at whether we can explain our main result away. So when we look at disagreement overnight, and on the left-hand side, whether activists trade or not, we'll also control for these other things during that time period. So returns, Amihud, bid-ask spread, and ex-activist turnover. And the paper will also put them all in one column. And we find that so the coefficient doesn't change when we add returns, Amihud, etc. We only get it to go down and go away when we control for activist turnover. So it looks like disagreement's effect on non-informed trading is what facilitates informed trading. And we see the same thing if we look at activist turnover, so the intensive margin. So it looks like on here, the coefficient doesn't fully become insignificant, but it definitely decreases in size a lot. So so we can see that again, not only are they more likely to trade when there is ex-activist turnover, they also trade more. So I'm not going to go through these too much, but we also ran a bunch of robustness tests. Results are robust to dropping 0 message days, controlling for overnight returns, including event fixed effects rather than just firm and date fixed effects, alternative liquidity measures, dropping the last 12 days, as I mentioned, prior to the filing date, because there's sort of a lot of trading going on there, and then controlling for message sentiment. We also looked at a similar setting. We try to get a little bit of external validity by looking at insider trading. And so just to conclude, because I'm I think right on time, but basically, again, in this paper, we look at how disagreement among mostly unsophisticated investors affects trading by informed investors, which is activist investors in our setting. And we see that it affects the extensive and the intensive margin through trading, through the liquidity channel, and particularly increased trading by non-informed investors. And we also showed that, again, activists shape real firm outcomes, and therefore we showed that disagreement among non-sophisticated or less sophisticated investors can actually affect not only trading volume, but can also affect actions that have real firm outcomes. Okay, that's all I had today, and I really look forward to Clifton's comments. And I will stop sharing.
I will start. Okay, was that everybody can see?
Yes, thank you, Clifton. You have 15 minutes.
Okay, moving the chat around. Make sure you can see my head, my big head. Okay, so happy to discuss this paper. And maybe, I don't know if you were here previously, but 2 months ago, Marina discussed my paper. So it was nice to have the opportunity to return the favor. Hopefully I will be as helpful as she was. Yeah, probably not, but I'm gonna try. Okay, so first I will just try to nest the paper in the literature a little bit. She did this, of course, I'll just sort of put my spin on it. And so there are a couple of papers that have looked at StockTwits in the past. One of the first one is this, at least to my knowledge, is this paper that said that they do seem to be dumb. It predicts returns in the wrong way, but it's mainly driven by non-local investors, and they say specifically in these overpriced stocks. So if they throw out the non-local investors, then they don't seem to be dumb. So they don't seem to be smart, but at least they stop being dumb and predicting returns the wrong way. And so, and a second more recent paper that Marina has with Tony they construct this measure of disagreement that they use in this paper and find that it predicts abnormal volume, and it matters more within an investment style than across investment styles. And that's what they emphasize in that paper. And so this paper also looks at StockTwits, this disagreement measure, and focuses on the effects it has on market quality, and finds that disagreement is associated with better market quality. And so I have a little vested interest in nesting the paper, since I have a related paper. And so there's another couple of Robinhood papers that are not StockTwit data, but are Robinhood data that look at the effects on market quality and liquidity. And so one is this paper that finds agreement with Marina's work that these investors, when they're present, that liquidity gets better. And so the reason I'm bringing this up is because I'm one of these et al. Here. That's the paper that I presented a couple of months ago here. And we find evidence that they actually make liquidity worse. And so how might this fit together with this paper and Marina's paper today? We say that it's sort of a disagreement versus herding. So are they trading on the same side of the market, sort of in a herding way? If they are, then that can move prices in ways that make liquidity worse, because they can last for longer than a couple of hours. Whereas on the other hand, if they're trading in opposite directions because they disagree, well, then this can just improve liquidity because it makes markets better, and they just sort of trade and improve things. And so we don't view our results as being in contrast with each other. They're sort of just picking up two sides of the same issue. So this is the StockTwits and or uninformed investor side of things. The other half of the literature is the trading by activist investors. And this is what Slava has worked on a number of times before, but most closely related is this paper where they look at when these activist investors trade. And they find, oddly, that you might expect that the adverse selection would be higher on those days, but they find that it's lower on those days. And they say, well, it's because of endogeneity. So they time when the activists want to trade. And so they tend to pick times of high liquidity, and they use limit orders. And so this is why these two literatures come together, is because they say, if they're trying to pick times of high liquidity, maybe when there's disagreement among these uninformed investors, that would be a good time to trade. And that is what this paper explores. And what they specifically find is that, this is just a quote from the paper, but one way to sort of summarize it is that these activist investors may observe disagreements from these uninformed investors, but they wait to see if there's trading. And if there is trading, then they know that that's going to be uninformed trading, and then that lets them trade. So disagreement by itself doesn't make them trade, but disagreement coupled with some uninformed trading, then they know that's a good time to go in. That is sort of my spin on how to interpret it. Okay, so they know this question. So do activists predict specifically the arrival of uninformed traders and react? Or are they just responding to market conditions? So this is, I'm sure they've thought about this. They're sort of agnostic about this process, about whether or not activist investors are paying attention to StockTwits, or if they're just reacting to market conditions. They don't take a stand on that, but it's hard not to wonder about it a little bit. And so one thing that I thought would be nice is to consider other types of informed traders besides activist investors, and they have done this now. So in the most recently revised version, they have added an appendix table that looks at opportunistic insider trading, and I like that. I think that right now, I think perhaps since it's a recent addition, it's just in the appendix, but I think it wouldn't hurt to make this a section of the paper and sort of discuss it a little more. And so, but these folks in particular, you may think that they're specifically not paying to StockTwits. And so insiders that are thinking this might be a good time to sell are probably not paying attention to StockTwits and realizing, oh, today's going to be a liquid day, I'll trade on this day. And so maybe these people are just reacting to market conditions. And one possible way to explore this, to see if it is just people reacting to market conditions, is considering others besides informed traders. For example, so index funds also trade a lot, and they're not known for being super sensitive to price impact, but there are times when they are, and they know that it's going to move prices a lot. And that is when there are additions or deletions to the index. And so they know everybody's going to fly into the stock. And so that's going to move the price a lot. And so some of the index funds do begin to trade it before it gets added to the index. And so they may also be paying attention to market conditions in some of these settings. And so you don't necessarily have to use Anserno data, because you could just use the these index additions and deletions. So you could say in the 5 days before a stock is about getting to be added to the S&P, is there more, trading? But Anserno data, I guess, would help. So you could see exactly when they do trade. So the Anserno data isn't great nowadays, but there was a window of time where you could see who was trading, and you could try to pin down what index funds are. So just something to think about. So is it unique about informed trading, or is it just people wanting to trade and minimize price impact, pay attention to market conditions? Okay. So one data question I had is, I need to speed up, I'm seeing. So like, how many days do we get a disagreement measure? And so it looks like on average, especially for the night measure, we get half a message, and the 75th percentile is still 0. And so it seems like most of the time we don't have any disagreement measure, and it sort of makes me wonder how often we do get a measure. And just to clarify, do we need 2 messages to have a disagreement measure, or is just 1 sufficient for disagreements? So 2 is required. And so, I mean, I think that nod was fine. so it seems like 2 is required. And so when you throw out 0 message days, do we need to throw out 1 message days too? I don't know, just sort of like, just a clarification question that you can respond to whenever you feel like. Okay, so maybe this has been done a little bit in your other paper, but I kind of wanted a descriptive table with just disagreement on the left-hand side and trying to explain where it comes from. Even if you have done that in the other paper, you could still look at it with an activist spin. For example, do they ever say the word activist in their StockTwits? Are activist stocks underrepresented or overrepresented? This earlier paper says they tend to like overpriced stocks, and that doesn't sound like activist stocks. And so just sort of thinking through the characteristics there would be nice. Also, this paper there is a contemporaneous relationship, it seems to be, between returns and disagreement. It would be nice to flesh that out a little bit. And I saw someone mention in the chat including more lags, and that would be nice. Okay. Another broad issue is that it seems like the 60-day period before when activists are trading feels different. This is the unconditional, on my left side is the unconditional relationship between table 2, and there does seem to be nice relationships between disagreement, both during the night and during the day, and the liquidity measures. But during the 60-day window, when the activist period, even when they're not trading, we have no relationship anymore. And it just kind of makes you wonder what's going on during this time period. And there is this trend that's going up during the 60-day period that the activists, this is in disagreement. And so you sort of answered this question a little bit with your figure from Slava's paper that show what's going on with volume and returns, but just kind of makes you wonder, what are they disagreeing about during this period? Is it volume volatility, which it'd sort of be nice to sort of flesh that out a little bit. So news is also something to think about. Maybe there is news that is influencing disagreement as well as the trading. It could influence liquidity that sort of affects both of these things. This is kind of obvious. And so you could maybe maybe it's not so likely that there's news, but it doesn't hurt to sort of look into it a little bit. Okay, so sentiment is currently considered a control, but it seems like that would be a nice way to get at the valuation channel more directly. So the valuation channel idea is that disagreements, if you have disagreement, these views down here are not reflected because of short sell constraints. So it's only optimistic views that are considered. And so that could have an effect. If only optimistic views are considered, that's going to push the price up, and that's going to make activists not want to buy because they want a cheap price. And so that was one possible channel that disagreement could affect things. But sentiment is just a more direct channel, because if everybody's bullish on the stock and they want to buy it, the activists are probably not going to buy that day because it makes the price too high. And so they currently include this as a control in an appendix table, but it doesn't, to me, it seems like that might be worth trying to address just by itself. I know disagreement is in the title. I guess I kind of thought about this more broadly as uninformed investors and activist traders. And that seems like that makes some of these questions interesting, broader than just focusing on disagreement by itself. So sentiment among uninformed investors, I still think that's interesting, and how that might relate to activist trading. So relatedly, so it might be nice to consider uninformed traders using measures besides just StockTwits. And so currently the paper looks at ex-activist trading by looking at the residual or the difference from activist trading. And it might be helpful because that of course includes all kinds of traders besides retail traders or StockTwits types of traders. It might be helpful to consider a more direct measure like the Boehmer, Jones, Zhang, and Zhang measure. And I know that Marina knows what that is because she constructed it when she discussed my paper a couple of months ago. And so it might be just as validity checked. We know it's related to abnormal volume disagreement. It'd be nice to know if it's related to a more direct measure of retail trading or Robinhood, ownership or something like that. And so that made me think more broadly that BJZZ itself could be used as a measure of disagreement or sentiment. If there's high retail trading that's balanced, a lot of people want to buy and a lot of people want to sell, then that itself indicates disagreement. But if there's high volume that's imbalanced, so everybody's buying or everybody's selling, then that sort of is consistent with sentiment. And then one benefit of this data is that you won't just get half a message per day. There'll be, for every stock, you'll have a measure of disagreement or of sentiment. And you could also measure it at very high frequency. So if you have a timestamp of when the activists are trading, you could measure this disagreement, this sort of retail trading based disagreement or sentiment measure. You could measure that in the couple hours before or in the 5 minutes before. And so that might sort of, it's the same motivation, it's the same story, but it just sort of provide an alternative measure of disagreement that might help support the analysis. And so my last comment I'd put at the end is just because I'm not sure what to do about this. I don't think it's really a thing that belongs to the paper, but just kind of thinking, what is the mechanism? So even if one possibility is they directly observe the StockTwits website. Alternatively, they're just trying to infer it from market conditions. And what are those market conditions? Where are they trading? So we think of activist investors often trading in dark pools. There's this, Mallier has this recent working paper that sort of studies where activist investors trade and find that so it makes the dark pool more informative. And so we know that retail investors often trade off exchange as well. And so just kind of made me think, who's learning from whom and where and what markets, and how does it translate into these visible liquidity measures that we see on the lit exchanges? And so just sort of food for thought. So that is my comments. I enjoyed a lot reading the paper and sort of helped me better understand the research that I'm doing and sort of think about these other papers as well. So thanks, and I look forward to other people's comments. I've been reading the chats, and so I have some of these same questions as well. And so I mean, after reading them, not beforehand, or they might have been in my discussion. So thanks.
Thank you very much, Clifton. But before we go to the Q&A, would you like to respond to any of the points, Marina?
Yeah, absolutely. So thank you so much, Clifton. These are all great suggestions, and I will respond to a couple where I have more to say than just this is great, we'll do it. So the insider trading, I think I agree. I think this is a very interesting setting. Right now it's in the appendix. First of all, it's obviously, we didn't have that much time to work on it. And more broadly, we thought it's an interesting question, as in the time, like if you think about time horizon for when they trade, like activist investors, it's nice, they're sort of really pressed for time. Once they start trading, they really have to trade, so they might be a little bit more sensitive to liquidity concerns than insiders when they, or like the short-term kind of liquidity changes. But we definitely, I'm glad you like that addition, so we can elaborate more on that and maybe move it into the main part. We did look briefly, and I'm glad you mentioned this because I've been pushing in our team for looking more at what they disagree about. I started working a little bit on the linguistic analysis of StockTwits to see what is it that they disagree about. One thing we did check, and it is they don't disagree about activists. So they do talk about activist investors a lot, but only right on the filing date and after that. So they, as kind of consistent with Slava's papers, they're sort of not aware of activist trading before the filing date. And I love we definitely, I did think about using the BJZZ measure. We sort of started working on it, but I love the idea of using it as another measure of disagreement and not just as another measure of uninformed trading. So we have not thought about that, and I think this will be a really nice addition to the paper. So thank you.
All right. Maybe just quickly adding to that BJZZ measure, because it crossed my mind. I guess what you might lose is this overnight versus daytime dimension, right? Because you're not going to see any trading during the night. But maybe then you can do it some other way.
Yeah, I mean, we could try with the disagreement measure we have right now. We found also, Antonio, in my paper, that it's sort of very short-lived. The disagreement, like the prior day, doesn't really predict trading on this day. So you have to use the overnight disagreement. Depending on the BGZZ sort of kind of measure, it might be that using the prior day might work too, because obviously then it's clearly lead lag. But that's an empirical question.
Ultimately, yes. Okay, great. Thank you very much. So
perfect. Thank you very much, Miguel, for organizing this, and thank you, Clifton, and everybody for comments. I very much appreciate them.
Thank you very much for contributing to the series twice, both of you. That's really much appreciated, and I really enjoyed seeing you here in both roles. So yeah, thank you everyone for joining. That was it for this webinar season. We'll be back after the summer, and meanwhile, be sure to check out the conference that we are kicking off in exactly 2 weeks from now.